Well, welcome back to the Chapter 17 Accounting for Income Taxes. This will be the second part. I decided to break this into three parts, so there will be a part three following this. But in this section, which will be pretty quick, is going to be on three aspects. One is what to do when we have deferred tax assets. Now, in accounting, we have that we've already seen that we recognize liability. We take a principle of conservatism. And so if we have a deferred tax asset, we have to ask ourselves, what are the chances that this will be realizable? And so for GAAP, they use the term more likely than not, which means more than 50%. And for IFRS, they use the term probable, which also means more than 50%. So the terminology is slightly different, but the effect is still the same, regardless of whether we're in GAAP or IFRS. Now, so under the principle of conservatism, if we have a deferred tax liability, we leave that on the books unless it is completed that we don't have to pay that. So if somehow we can write that off completely, but we don't make an allowance for a liability that we may not have to pay. Until we can write it off completely, we leave it on the books as a liability. But a deferred tax asset is slightly different, right? This is a future benefit. So in order to be conservative, what we have to do is we have to write this down if we feel that it is impaired, or in other words, we may not be able to use that asset to its full extent. So deferred tax assets may have to be written down. And we do that just like we do warranty expenses or bad debt expense. We use an allowance account for that. So how much of this might not occur? So what are the chances, what's a situation that we might not get to use a deferred tax asset? Well, one of the ones that comes to my mind is if a U.S. firm is doing business overseas, we get credit for, we get a tax credit that we can use for the taxes that we pay to a foreign government. So it actually offsets any taxes that would be payable to the U.S. government. So for example, let's say that we were doing business in the country of Pineland, and Pineland has a 15% tax rate. Well, in that case, and the U.S., of course, now has a 21% tax rate. So when we do business over there in Pineland, we would pay their 15% tax rate. Then when we come over here, we would pay 21%. So let's say we had $100 of income. We would pay Pineland $15 of income. Then when we come to the United States, we would also report that $100 of income to the United States, which under the new tax law would be taxed at 21%, so we would owe $21. But we would get a tax credit that we paid to Pineland of $15. And so we would only have to pay the U.S. government $6. And so under that scenario, we get the credit, and so we can use all of that tax that we paid to Pineland. But let's suppose the other is true. Let's say that Pineland had a tax rate of 25%. So we do business in Pineland and we generate $100 of income. We would pay Pineland $25 in tax. We come back to the United States. We would report $100 of income. The tax liability in the United States would still be $21, but we would only get to use the tax credit up to $21. We wouldn't get to use the full $25, right? We could only offset that. We wouldn't get to use that tax that we paid Pineland to offset other U.S. generated income. So the chances are, if that were true, we would never get to use that $4 extra difference that we paid Pineland. And so that's a case where we wouldn't get to use a deferred tax asset. And that now under U.S. laws, that money is taxes are payable once the money is repatriated, and that's how companies like Apple and Microsoft are able to have so much income at such low tax rates, because they do business, like I think they go through Singapore for their Apple goes through Singapore for their Asian businesses, and they end up paying about a 2% tax rate. And as long as they don't repatriate that tax, they have no tax liability in the U.S. Now that's changed under some of the new laws, but under their old income, they don't have to repatriate that. All right. So that's the deferred tax asset. We'll set up an allowance account. We'll go through those in the various problems. The second thing in this section is what happens if there is a change in tax rates. We have either a deferred tax asset or a deferred tax liability, and the legislature comes along and changes the tax law. So it could go up, it could go down. And so if that's the case, we have to adjust that deferred tax liability or that deferred tax asset to reflect the change in tax law. Now, under GAAP, we are only allowed to use the tax law that is enacted. And what that means by enacted is what's on the books. Now, so if they pass it, so if Congress were to pass a law, but it doesn't go into effect until next year, that would still be enacted. We could use that new rate for the next year if we expected to collect money in the next year. So we could do that. Under IFRS, it's a little bit different in that they use the term substantially enacted. And I'm not quite sure what substantially enacted means. If it's gone through, if it's gone through the books or how that enabled. But GAAP is fairly straightforward. We use what the current tax law is, and if it changes over a period of years, we can use those years. The final thing that I want to talk about in this is NOL carrybacks and carry forwards. As you know, companies don't always make money. Sometimes they lose money. And this year might be one of those times for a number of companies, especially around here in the oil business. And so those are called net operating losses, or NOLs. With a net operating loss, under the old tax rules, you could go back 2 years and forward 20 years. And so what would happen is you would go back, you would carry that loss back the first year and then the second year, if you had enough of a loss, and you would get a refund for taxes paid in those 2 prior years. Under the tax law that was actually passed in 2017 and started in 2018, we are no longer allowed to carry backwards on NOLs. We can only carry forward, and it now goes forward 25 years. And so, but we're going to go ahead and work the problems that include carrybacks, because we haven't had a recession like we're probably fixing to enter since they passed that tax law. And at the time, I wondered if that rule on not allowing NOL carrybacks would stand the test of time if we actually went through a recession. And so I would give it better than 50% chance right now that you will see Congress reverse the NOL carryback rule and also the interest rule, which doesn't affect us in financial accounting. But I expect them to reverse a couple of tax provisions that they enacted in the 2017 Act because of the detriment it will do to business. I actually, this is probably a little cynical of me, but I actually figured they always would do that. But it was just a game that the Senate was playing in order to encompass their rules that taxes had to be balanced over a 10-year period. And so that was one of the things that the provisions that they took into account. So anyway, so if we get that, so a carry forward, we just use a tax benefit. So we'll end up with a deferred tax, a net tax benefit. And if we have a carryback, it'll still be a tax benefit, but it will be offset by a cash receivable from the IRS. All right, so this concludes the second part of the lecture, and I'll go work some problems now. And good luck.